Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, 3323.
Correct.
Just after the close, live from the Fixed Income Trading Room with the Moose, Director of Fixed Income, CEO and President. If you hear any music outside, it's the beginning of a blues festival down here in Sarasota. And by the way, if you get to Sarasota, which is a beautiful area, if you get anywhere from Tampa to Naples, give us a call, come in and visit us. We like to meet our friends, our clients. We meet our clients all the time. Keep us in mind, beautiful place to be. Moose, fixed income market's doing a little dance this week.
Little dance. You wouldn't know it from the way things reacted because as you sit here today, you go from a 2-year bond in Treasuries at a 485 out to a 30-year bond in Treasuries at a 390. So it is steep from the beginning all the way out. You look at the action for the week and, you're up maybe 3 to 5, 6 basis points across the curve, not much. But if you had measured it yesterday, you would have been up really 8 to 12, depending. So right. Bigger change today. Nothing much on news. I think the market was basically tired of yields going up, and they wanted to basically, take a day off. But I'll tell you this, we have one chart today, and it shows you the Treasury yield curve back in the end of October when it was really cheap, then at the end of February when it was fairly rich because we had a heck of a rally.
And when you say cheap, what are you saying, Jim?
I'm saying cheap relative to how far it had gone from the beginning of the year. So when you think that the 10-year bond started 2022 at a 150 and by end of October was at a 425, that's extraordinary because you're almost bordering on tripling that. So we saw a rally in bonds, a lot of it taken with yields down because it was driven by better CPI numbers. And then about a month ago, we got a jobs number that kind of threw everybody out of the chairs, that 500,000 jobs created. And since then, the market in bonds has backed off. Yields have gone higher. People are fearful of the Fed continuing to raise rates. Most of the talking heads, on business television have taken that stance. The actual numbers haven't really shown that much more strength. It's just that one number threw everybody into a tiz. So where you sit now, short-term rates are as high as they have been in many, many years.
15 years.
Yeah, and that part's true and will probably keep going. Longer-term yields, we're kind of in the middle of where we were basically in November and where we were at the beginning of February. So kind of a midpoint. We'll know more next week when we get a jobs number on Friday.
Yields are really dictating action across all asset classes right now. And if we look even on the equity side, you've had to be fairly nimble to consistently make money. Now, we always talk about having a short-term bucket investment and trading-wise and a longer-term bucket, and you treat those buckets differently. But one thing, and I'll go back to conversations we had over the summer into the fall when rates were ripping, and they're ripping a bit right now. If we go back to the first decade of what they call it the aughts, right? From late 2004 through 2006, Fed raised rates a quarter point 15, 16 times in a row. What worked? What's funny? The same thing that's working today.
Right.
Basic materials, industrials, small caps with a value tilt, and international. So go back and look at some of those charts. Right. I remember trading them, and you really had to have that type of thinking. What had worked the previous few years wasn't working. That growth tilt, notwithstanding the real drawdown in the NASDAQ, right, from 2000 through 2002. It's just funny how markets always have a memory. Now, once you start leaning on that memory too far, you can get a little whipsaw.
Absolutely.
But we're tending to still look for example, in our core portfolio at a value tilt with a small, mid, and large cap mixture. And we're surviving. We talk about it on our calls all the time. Sometimes the name of the game is surviving, keeping your capital, taking shots where you can, taking swings at decent pitches, if you want to throw a baseball saying out there with spring training started. And I think that's where we sit today. Nothing wrong with holding cash when cash is paying 4.5%.
No, and I would add to that, when you think about it, on the tax-free side, where things like 2-year treasuries or 1-year treasuries are paying more, even on an after-tax basis, than a lot of municipal bonds where the demand is so strong. We're using taxable bonds in a lot of the muni accounts just as a placeholder because you can make sense out of it.
Yeah, you bring up a great point there just before we wrap up. The nice thing about having separately managed accounts in bonds, I'll do a little sales pitch here, in bonds, is you have flexibility.
Right.
So in terms of a period now where you're looking at short-term treasuries, at 4.5% to 5%, what's wrong, even for a tax-free investor, what's wrong with buying that kind of yield? Don't forget, you have no state tax on treasuries,
right.
So you can say partially tax-free.
Right.
Anyway, a lot of flexibility in a separately managed account versus a mutual fund. We like that. John does a solid job there. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos, and enjoy the weekend. We'll be back at it on Monday.